The Dhandho Investor, the Low-Risk Value Method to High Returns by Mohnish Pabrai, is a practical guide to value investing, inspired by the entrepreneurial spirit of the Gujarati Patel community, who are known for their success in low-risk, high-reward investments. Pabrai distills his investment philosophy into easy-to-follow principles, rooted in Warren Buffett and Charlie Munger's teachings, while emphasizing a heads, I win, tails, I don't lose much approach to investing. Pabrai introduces the concept of Dhandho, a Gujarati term meaning business. He uses the Patel community as a case study to show how they took significant yet calculated risks, often starting with limited capital to achieve extraordinary business success. This framework forms the foundation of his value investing philosophy. Story of the Patel's Pabrai shares the story of how the Patel community, starting with limited resources, came to dominate the motel industry in the United States. Key insight: the Patels minimized risk by buying low-cost motels in poor condition, fixing them up, and leveraging family labor. This approach mirrors value investing, where buying undervalued assets with little downside risk can lead to high returns. Pabrai outlines the core framework of Dhandho investing. Focus on low-risk, high-uncertainty opportunities. Seek situations with limited downside but significant upside potential. Example: acquiring distressed assets or investing during market turmoil. Invest in simple businesses. Choose businesses you can easily understand, avoiding complexity. Leverage a durable competitive advantage. Invest in businesses with strong moats that protect their market position. Bet heavily. When the odds are in your favor, take concentrated positions in high conviction opportunities. Definition of a moat: a company's sustainable competitive advantage that protects its profitability and market share. Types of moats: cost advantages. Companies like Walmart or Costco with scale-driven cost leadership. Branding: iconic brands like Coca-Cola that create customer loyalty. Switching costs: businesses like Microsoft that are difficult for customers to leave. Network effects: platforms like eBay or Visa that become more valuable as users grow. Pabrai emphasizes that identifying and investing in companies with durable moats increases the likelihood of long-term success. Concentrated portfolios: Pabrai advises against over-diversification. Instead, focus on a few high-conviction opportunities. Infrequent activity: wait patiently for the right opportunities. Avoid frequent trading or chasing short-term market trends. Inspired by Benjamin Graham's teachings, Pabrai highlights the importance of buying assets at a significant discount to their intrinsic value. Example: if a business is worth $100, aim to buy it for $50, ensuring a margin of safety against unforeseen risks. Pabrai introduces his investment mantra: heads, I win, tails, I don't lose much. Invest in situations with asymmetric risk-reward profiles. For example, buying distressed companies or turnarounds, where the downside is limited, but the upside is substantial. Mantra application: look for companies with low debt, strong cash flows, and significant undervaluation. Pabrai argues that you don't need to reinvent the wheel. Instead, emulate successful investors like Warren Buffett, Charlie Munger, and others by studying their investments. Key tactic: track the portfolios of top investors through 13F filings, analyze their holdings, and learn from their strategies. Pabrai advises against investing in companies that rely on continuous innovation, as innovation is risky and expensive. Key insight: instead, focus on businesses that copy proven ideas and execute them better or cheaper. For example, Walmart copied Kmart, but outperformed it through better execution. Compounding wealth. Pabrai explains how reinvesting earnings leads to exponential growth over time. Rule of 72, a quick way to estimate doubling time. Divide 72 by the annual return rate to calculate how long it will take to double your investment. Pabrai introduces the Kelly criterion, a mathematical formula used to determine the optimal bet size in investing. Bet more when the odds are in your favor. Bet less or avoid situations with poor odds. This approach ensures that you maximize long-term returns while minimizing the risk of ruin. Pabrai presents a checklist to evaluate investments. Is the business simple and easy to understand? Does it have a durable competitive advantage or moat? Is the business available at a significant discount to its intrinsic value, providing a margin of safety? Does the business have limited downside and significant upside, indicating asymmetric risk? Is the business run by competent and honest management? Pabrai applies the Dhandho framework to real-world examples, demonstrating how these principles can lead to successful investments. Example 1. A distressed steel company acquired during an economic downturn. Example 2. A retail business with a strong brand, but temporarily declining performance. In both cases, Pabrai highlights the importance of patience, discipline, and adhering to the framework. Pabrai concludes by reiterating the simplicity and effectiveness of the Dhandho approach. Focus on low-risk, high-reward opportunities. Be patient and disciplined. Learn from others' successes and mistakes. Concentrate your efforts on a few high-conviction bets. Key takeaways. Heads, I win. Tails, I don't lose much. Seek asymmetric opportunities with low risk and high reward. Margin of safety. Always buy below intrinsic value to protect against downside risks. Few bets, big bets, infrequent bets. Focus on high-quality opportunities rather than diversifying excessively. Clone the best. Emulate successful investors and proven business models. Invest in moats. Choose businesses with durable competitive advantages that ensure long-term profitability. Pabrai's Dhandho investing principles are simple, practical, and rooted in common sense, offering an accessible framework for aspiring investors to achieve consistent, low-risk returns.